Our next guest says the market may be in the early stage of a melt-up. Let's bring in Ed Yardeni, president of Yardeni Research. That certainly isn't, I don't think, consensus, and I guess a lot of people would be surprised by that, Ed. I mean, We've seen it, but every time we see it where we start out a day sort of either quiet or down in the morning or maybe up a little bit, and by the end of the session we're up 200 or 300 points. It's happened again and again and again. That's the characteristics. That's the characteristics of a melt-up, and it's being met with a lot of skepticism. So maybe the ingredients are right.
Well, I think that when you look at the performance of the market, the best way to think about a melt-up is what's the valuation multiple doing relative to earnings? And the valuation multiple has had quite a run. It's up almost 50% since the beginning of this bull market. And earnings have also been improving. So the question is this a PE-led melt-up or an earnings-led melt-up? A PE-led melt-up would be reminiscent of the late 1990s. An earnings-led melt-up would be more sustainable. I think at this point, I'm pleased with what's going on the earnings side. I think earnings are going to be pretty good in the third quarter, but valuation is definitely stretched. It's not as bad as the melt-up in the late 1990s, but it's getting there.
So a melt-up, if we're already in it, maybe we're partially through it, but since the election is in only 15 days, I would imagine that any melt-up would have to go right through the election and then into maybe 2025. Does it matter to you how like so many things, maybe the election is just another one of those data points that may or may not matter much to what the market does as far as the big picture?
Yeah, I hope that's the case, but this is probably going to be a very, very close race and maybe a bitterly contested one, and I don't know that would be a good backdrop for a melt-up. The market might have some second thoughts about that. The other possibility, of course, is a Democratic or a Republican sweep, in which case the market's going to have to be very concerned about deficits being even wider and possible inflationary consequences. And in fact, the stock market's kind of ignoring what's going on in the bond market. Ever since the Fed lowered the Fed funds rate by 50 basis points, guess what? The bond yield's gone up by almost 50 basis points. And so the bond market's signaling that bond investors, my friends, the bond vigilantes, are starting to stir. They're not particularly happy with the potential inflationary consequences of what the Fed did, because the Fed, I think increasingly it's clear, they might have overreacted with the 50 basis point cut and stimulated an economy that doesn't really need stimulating.
So what's the thesis for earnings growth continuing to be solid and above trend? Is that include? Are you talking global? You talking China? You talking Europe recovering, or everything here in the United States?
Yeah, everything here in the United States is basically the story. I'm not that convinced that China is going to be able to stimulate its way out of a historic bursting of a real estate bubble, and Europe still has lots of issues like competition from China. The German auto industry is getting really clocked by what's going on with China's exports of electric vehicles. I think the U.S. continues to surprise to the upside. The labor market, at least in the latest data, looks pretty good. You know, if you don't like the latest data, wait for the next batch and maybe there'll be a revision. But I like the latest data. It looks pretty strong. The real GDP is tracking at over 3% for the third quarter. There has been no landing. There hasn't even been a soft landing, quite honestly. And as a result of that, I think earnings are going to be quite good. And I think the part of the story is the economy's resilience, and the other part is productivity and profit margin making a comeback. So the earnings side is pretty good. Look, my melt-up concerns, I try to convey my concerns by providing some subjective probabilities. And when the Fed lowered the Fed funds rate by 50 basis points, I raised the subjective probability from 20% to 30%. I'm still using 50% for what I call a roaring 2020s scenario, and then the rest of the 20% is trouble, geopolitical problems, and maybe even domestic political problems.
Ed, even though I said the election doesn't matter. So what do you think could impact earnings either positively or negatively? So on the one side, you've got the possibility of more tariffs. You've got more than a few tax cuts on the table. The 2017 would be extended. We've heard even the SALT cap might come off. On the other hand, if it was if the Democrats were to win, you could conceivably have corporate rates go up to 28%. You could have capital gains rates increase. You could have quite a bit of spending on social programs. I mean, there's a lot of different things we're talking about.
A lot of different things.
Which would be more of a threat to your strong earnings case?
I think you've covered it pretty well, Joe. All of the above. I'm rooting for gridlock. Our founders came up with this system called checks and balances. On Wall Street, we call it gridlock. And I hope that all the extreme policy proposals that both Trump and Harris have made just run into gridlock. Some of them are extreme on the tariff side, on the tax side for the corporations from Harris. And so I think, the market has ignored politics, and I think rightly so, but I think it may be harder to ignore politics once we see what the results are. If the results are gridlock, then I think melt-up is actually becomes more possible because then there's some of the extreme populist policies. Both politicians are promising their base everything they could possibly wish for, but I'm wishing that the political system gridlocks on them.